What's happening? Happy Monday. Interesting week we have here with holidays, but yet we still packing in some information. Jerome Powell speaks this week. We have ADP non-farm. We also have FOMC minutes, and then we have non-farm payroll right around the old holiday on Thursday.
Yes, it is going to be a hectic week, to say the least. I mean, starting off with a bang, we had PMI data come in softer. I don't know, you might have been listening to a little bit of that conversation, Chris. We were just talking with Ivan about the idea of, is there a possibility that July meeting could swing into becoming a live meeting? I think right now there's like a 10% chance that we see a rate cut in July. It's not very high, but you also have to understand it's a 10% chance before we get the data for July. So we could, between now and then, see ginormous swings and hence volatility in the markets between now and the time of that July meeting to when they actually make a decision whether or not they're going to cut or hold interest rates. I mean, is it possible, Chris? This is my other conspiracy. Frank and I keep talking about this. Is it possible that people are people, human beings are human beings, they want to keep their job, and the presidential debate seems to have gone really well for Trump, and he's made mention that he would do some changes to what the Fed's got going on if he were to take presidency? Is there some conspiracy work here where Fed officials may want to keep their job? Maybe if data comes in soft, they'll be more willing to cut interest rates sooner. Is that possible?
I don't think it's going to matter if Trump wins. I don't think anybody in the Fed's going to feel comfortable. I don't know. I mean, we're talking about
what I'm saying, Chris, is that if there's a possibility to assist the incumbent, candidate, Biden,
but will it be rate cuts? I mean, are you seeing that right now? It's like, and
I am. Yeah.
I mean, the fact that the Democrats are maybe trying to scramble to find a new candidate, it's like, who knows how that's going to be received? I mean, I'm fine with it. I could care less. I'd rather vote for four years of a shadow. It's like take zero presidents right now. It's like, this is a joke. I hate the fact we're even talking about this, and it's going to be now front and center until November.
Exactly.
To get the conspiracy, I mean, I do think that the Fed cut that is the most probable right now, September, is really what the market expects. The market's done a really nice job of not panicking, expecting 5, 6, 7 cuts and ripping the way that it did from Q4 to Q1, and now the market's backpedaled into maybe thinking one cut, maybe 1 or 2 cuts by the end of the year. If the Fed cuts in September, I really think that is just a sigh of relief for the consumer, a sigh of relief for small business, a sigh of relief for the housing market. I mean, to consume some interesting content this week. The consumer in the U.S. is not buying goods, but they're buying travel and
I've seen that
leisure
too.
And so I mean it's hotels, it's cruise lines,
Carnival. I've seen that in the earnings stuff too.
So that's been where most of the money's going as far as buying. Also, most of the consumers, surprisingly, like our real estate market is keeping the U.S. consumer pretty flush, pretty liquid, which isn't a great thing because, I mean, if you're sitting on equity in your home, the only way you have access to that is by borrowing against it. But when a lot of people have seen over the last 5 years, housing prices increase, 50%, sometimes 100% in certain areas in certain cities, that's a lot of cash to tap into that. Hopefully, if you're borrowing on that, you're borrowing at a affordable rate or you're leveraging that in some capacity. But it was interesting. Like a lot of people, it's like 96%, 97% of mortgages in the U.S. are fixed rates and not variable, right? So the idea of, we don't have this crazy thing like in Canada where every 5 years they're reassessing variable rates, and so you go to the market. So, I mean, anyway, the Fed cutting, I don't know, man. I mean, I hear the arguments both ways. I also hear that the Fed shouldn't cut. I hear that if the Fed cuts, it's going to flare up inflation again. These markets going to rip. You got, I mean, just you said earlier with Ivan, if small caps rip and gold rips and all these things are going higher, the Fed can't contain that type of asset appreciation, which also puts us into a bit of a bubble. I don't know. So, I mean, it's not going to be easy. And this is the same conversation we've had many times. Very few times in history has the Fed gotten it all right. And if they decide to cut and the market doesn't react the right way, or the market reacts, crazy bullish and bubbly, or the market tanks, that's the Fed breaking something, or the Fed doing something stupid when they should just stay out of the way. But with this year's election, the Fed may be a little bit more political in that sense, where sure, if they cut, maybe it's good for the market. But I think the Democrats right now have a lot of problems where they're trying to figure out, who to vet, who to get in there for a potential candidate. And like I said, man, I don't even care. It's like, I go back to a South Park reference. It's, it's a turd sandwich or something else. I mean, you can fill in the blanks, but you've seen the episode I'm talking about. But you don't have good choices, and it just sucks to be thinking like that's the best we can do as a country with a stupid two-party system that gives you nobody. And certainly in this case, it's not any better. So, like I said, I don't vote. I don't trade politics. But certainly you trade policy, because that has a big influence on what the market does for the next 4 years.
And speaking of policy, I think that, the market definitely kind of, so this is TAN, this is the solar ETF that I talk about periodically, obviously helped by a lot of the tax incentives and the kind of the Biden administration you're making kind of a push for this stuff, or at least the expectation that they will do so or continue to do so. So TAN traded much lower here, right around when the debates happened last week. Yeah. So I think that that's kind of interesting, because that is kind of a tell of what the market is feeling, at least for now, about how the debates went. And as you mentioned, we'll see what happens with the Democrats, whether they change out who their candidate is or whatnot. But in terms of financial markets, I think that you're looking at a lot of potential inflation. I would agree. Either ways, they both spend a ton of money in their respective administrations. Neither of them is exempt from that, and either one will again probably continue to do so. So, I think that what that does is it kind of keeps me cautious as to what I want to do with stocks, what I want to do with markets, and I kind of continue to like my idea with gold and silver of just that potential kind of commodities hedge this year, just because of their lower correlation directly to the stock market. I do think that continued spending could keep continuing the stock run for some time. I'm willing to stay long tech if I can keep it, and other areas. The Russell is an interesting one for me. I think it's going to be at some point the trade of the trade of the decade, maybe, is small caps being so blatantly underperforming for some time now, for several years really. And I think that will change at some point, but you're probably going to need to see continued spending. You're going to need to see inflation kind of normalize a little bit and growth kind of reaccelerate for the Russell to finally get up and running. So we'll see. What are your thoughts on the Russell right now?
Yeah, I mean, it's the best index catch-up trade we can have right now. I mean, I look at all of these. The SPY and the Qs, I think, need to have a pullback. This week with kind of an odd week with a holiday right in between. I mean, this is last week's price action, right? I mean, Friday was a crazy day to finish out the month and finish out the quarter. I was long the SPY to a 548 call, had some extra profit. I turned a 64-cent debit into like $2. That was all on Friday's movement, and then we tanked on Thursday or on Friday as well. I think Frank had a long put at 550, which paid pretty well for the day, but I think he's holding it to today. Hopefully, it goes a little bit lower for him. But this is what I'm looking at. If we break last week's low, okay, and we take out not just last week but the week before, then our CPI gap comes into play, which puts us down into like the 537 area. And then, I'd say we're a little bit more vulnerable to the downside just to have a correction. We're talking, 2%, not in a single day. I mean, that's been the one thing, we're 350 days or something without a 2% day. But we could have a 2% pullback. We had a, 6-7% sell off in April. So let's see if we can get like a 3, 4, 5% correction. But maybe we don't. I mean, we have 2 weeks of indecision, but the SPY, overstretched with divergence, the Qs overstretched with divergence, the Dow, I like the Dow for this. I mean, they kind of look a little bit toppy, Nick, but I see a potential ascending wedge where we have this push up here, maybe some consolidation on the Dow. It does look a little toppy where if it starts to break and get vulnerable, yeah, it doesn't look great. But ascending wedges usually are facing this. They deal with some indecision. Get rid of my squiggles here. And once we have this market pushing up with equal highs, equal highs, equal highs, equal highs, this is the blow off you're talking about. You know, the Dow might be okay. We might, if we see some heavier sector rotation, the Dow probably benefits from that, even though it's price weighted, which is, I think, at some stage is helpful, even though it hasn't reached all-time highs like we had in the SPY. But the Russell, I keep going back to the Russell. I just want to see this trade work, man. I mean, if you go IWX, that's Russell growth. If you go or the top 200 rather, what is the what's the small cap growth? It's IWF for growth and IWX for the top 200. Your Russell, I'm long the Russell. I'm long Russell futures. I'm long the IWM, but it's with options, so I'm essentially just collecting income. But this trade to get to the all-time highs is 21%. I think my favorite thing about this is you can measure it. So are we going to have a 20% blow off in the SPY and the Qs? Maybe. But to see this as a catch-up trade, if we have a rip like we had in late 2023, the Russell can outperform everything for that, you know, quick rotation. There's lots of opportunity right here. I just think it needs to be confirmed. So, I mean, how much longer does this go? Maybe through the end of the summer. Maybe if you're right, maybe we come into the summer and the Fed cuts in September. Maybe this is what gets the market going, and we just have September, Q4, doesn't matter. Blow the top off, let this thing rip. Both parties, like you said, whoever comes into the presidency, whether it's switching up the entire checks and balances with a new administration, they're both going to spend money. I don't think anybody thinks that like Republicans come in and we're going to austerity. There's no freaking way. This is going to be about decreasing the dollar. This is going to be about, you know, influencing the markets and decreasing, you know, taxes. And it's, I mean, if it's economic focus, it's going to be everything. It's going to be the kitchen sink. It's like people are swinging more to the right, more to the left. And I think the government's doing the same thing with fiscal policy. They're swinging more and just spend and print, just depreciate, just debase. So, you know, I like hedges. Gold is good. Silver is good. Two of my favorite trades right now. And I want to remain long equities. I think the indexes are pretty straightforward. I think the market's going to continue to ignore a lot of things this year. But it just feels like we're rattling off all these things. And it's like, yeah, the market can go higher or the market can tank. But at the same time, we have to be ready for, there's also an in-between, Nick. The market doesn't do anything. There's an in-between. The market just kind of slowly, steadily hums along. And everyone wants these blowout tops, or everyone wants this crash. But the reality is what happens, the market just kind of steadily does what it does, which is it tries.
Well, and that's the thing is, I think a lot of people are so used to last couple of years, which have been a very trendy couple of years.
4 years, man. You know, we haven't had it sideways in 4 years.
Yeah, it's been just trendy one way or the other. And then, you know, if you go back in history, there are periods like 2015, which were just, you know, well, let's take this as kind of a, let's stretch this out. You could have said basically from like August of 2014 until, you know, February, March. I mean, really all the way until here, you had this range on, you know, the NASDAQ for several months. So, and then, you know, there's also periods, let's see if we can just go back further. You know, the 2000s were one ginormous range, which was an incredible, you know, that was another thing too. Between, I think, 2000 and 2012, value outperformed growth. And that's a long time for value to outperform growth. A lot of people, again, in this bull market phase, they believe that growth just simply outperforms value. And while it may over very long stretches, there's also long stretches where value can really outperform, especially if we enter into a bit more of a growth slowdown. If that does occur, you know, you very well may see the Dow Jones do well. Now, again, that growth slowdown would not be good for the Russell, but we may also just see, like you're saying, a phase where we just kind of go sideways, where we don't see a massive, you know, shift in the economy. Maybe the economy just kind of hangs in there. It's not super impressive. It's not super terrible. Maybe that's the catalyst to a sideways market, Chris. People just speculating both ways. Oh, it's going to slow down, or it's going to heat up again. Maybe it just kind of hums and it doesn't like, yeah.
Let me throw some numbers out at you. I thought this was really interesting this weekend. Just listen to some good content. the tale of two markets. Just in 2024, some of these gaps and some of these spreads and some of these differences between, this index or this instrument versus this instrument. So U.S. large cap, just take the SPY versus U.S. small cap. Okay, you can take the Russell, you can take the IJR. Small cap versus large cap. Large cap's around 15%. Small cap, -2. About a 17% spread in difference in performance. That's a big difference, okay? U.S. growth versus U.S. value, about a 15% difference. Growth obviously outperforming value. The U.S. versus international, about a 10% spread. U.S. is up 15%. International is up about 5%. We haven't seen higher highs in Europe. We haven't seen higher highs in Japan. We haven't seen higher highs really anywhere in the world outside of the U.S., right? We saw higher highs into March and April, but those major indexes, if you look at the DAX, the FTSE, the Nikkei, they have not made higher highs since March or May. But the U.S. is outperforming by about 10%. You look at this all the time. SMH, semiconductors up 48% for the year. Take one of the crappiest sectors in the U.S., that'd be regional banks, down 7, almost 8%, 55% spread. So that's your tech versus value, if you will, or just finance. Short versus long duration in bonds. Okay, short duration's up 2.6, long duration down 8%. That's a big spread in the difference in bonds. We only have about a 0.3% inversion right now. But somebody asked me this morning, what about the TLT? What about the 20-year? If you look at the 20-year, the yield's not cracking. If we go to the U.S. 20-year, U.S. 20-year. Yeah.
I'm listening, Chris. I just got to shut my window. One sec.
Oh, you're good. So the 20-year bond yield is right here at 4.73. I mean, it'd be nice to think like, if I just, parked money for the next 20 years, didn't have to touch it, collect 4.73% a year, risk-free, it's pretty good, right? But the issue is, we're still in this 350, almost 400-day inversion. We're getting to that 2-year window, which is going to be really interesting. October 2024 is going to be 2 years since we inverted. It's got to matter. It's like the 3-month and the 10-year have typically always been right when it comes to some type of recession indicator. Same thing with the 2-year and the 10-year. We can actually look and see that spread. And then dollar versus yen is another one, like crazy tale of two markets, where I talked about this morning, Nick. This is one thing. I don't know if you and followers are trading the yen, but what's interesting is the Japanese yen and the Bank of Japan don't necessarily intervene when it comes to a certain price. But what they do is they tend to intervene when it comes to rate of change. And so when we had this intervention right here, this October, November of 2022, that was a depreciation on the yen. We started intervening here. It was about a 10 to 11% move, and we ended up stretching around 16% before they really started to put that pressure on with repricing the yen. We're looking at the same type of window. I just said ballpark wise, if we take this recent run from let's say the last intervention, we take the same low. So you go to this spot right here on the yen, right here. If we go up another, let's say 9 to 11%, where the Japanese yen gets weaker, that might be another level of intervention. And I'm ballparking this, but I'm saying 165 to 170. So I am not calling the top at 160. I said to traders, if we hit 160, doesn't mean I want to be short. If there's no confirmation to sell it, don't sell it. This just stays in drift mode. But 165 to 170, again, it is so difficult to trade as a currency trader. You can't just anticipate and get rewarded by the Bank of Japan. Maybe it can, but that's probably not going to come with I picked the perfect stop loss for a Japanese yen intervention. That's probably not going to happen.
Yeah, very, very difficult to do for sure. And you've got dollar yen, as you mentioned. The chart just looks just like it's just going to want to keep trending for now, but we'll see where that goes. And as you mentioned, the rate of change concept is interesting. It would make sense that they would kind of want to jump in when it's pushing aggressively to try and jump in front of something that's happening.
And so, and let's think about the timing, right? Let's say that this just drifts, and it's maybe not crazy running, but look at every day if the yen goes up 50 points, and then we pull back and we go up another 50 points, we pull back. It's like if we for the next 2-3 months before the Fed starts to cut in September, before if the Fed cuts, but I think they probably will. I still keep going back to something's going to break. In my opinion, the Fed's not going to get away with like this type of extreme policy that we've seen the last couple of years. Something's going to break, and that type of event. Another thing that can make your plays really easy. would be, look, if I'm right about this and just kind of ballparking that 165 to 170, it doesn't mean I want to short, right? It just means I'm looking to see if the yen's going to deleverage, if the yen's going to all of a sudden be a repricing event, then it would be pretty simple. Let's see if we just break the inner trend line, go to an outer trend line, come back and retest previous resistance. Because when it comes to these moves, it is actually obedient. Like this swing right here from low to high, it pulled right back to the 50% on a fib swing. So it works,
Yep.
but we have to wait for that to happen. So I'm watching the Japanese yen from that regard. And also, if you want to know, my gosh, the market's going to tank. All you have to do is look at this. Okay. If you look at high yield bonds, this is essentially your widening credit spreads. One thing that's always been a precursor to a volatile market and potentially things breaking loose is when this changes. Okay. Look what happened in February and March of 2020. Right during when we had the expirations from February to March of 2020, look at what JNK did. Dumped.
Yep.
Okay.
Yep.
If right now you see that JNK is going nowhere, this means that credit spreads are pretty tight. This means that the overall spreads in the market are tight. If these widen, this is where things get worse. Okay. So if we start to see this going down, sure, volatility is coming. Market's probably going to sell off. To what degree, we'll find out. Okay. But if this is steady and this is sideways, the market's just going to hum along. And this is where, you read we expect a bull market. We expect a rip. We expect a blowout top. Pausing or drifting or going a little bit sideways, not having it be super exciting is actually okay. I have a lot of positions that should be profitable, very profitable over the next 30 to 45 days. Take some profit, redeploy, do it again and again and again. And hopefully that's the case if we're going to go sideways. But it just seems like you got to price in so much of a black swan and so much of your cover your butts. And and it's okay. You should have something where at least, if we have a 10 to 20% drawdown on the markets, you're not on the hook for all of it. You're trying to be as diversified or non-correlated as possible. So you're not just going tick for tick with what the market's going to do on a large cap basis.
Yep.
So, but anyway, I'm just watching JNK, and I think that the Japanese yen was an interesting piece of news this weekend to kind of give me some perspective on, okay, so it's not a level that they intervene at, right? This isn't the Euro Swiss pegged at 120. The dollar yen is not pegged at 160. It's just rate of change. So if it's 9, 10, 11% that it appreciates, that makes a big difference when the Bank of Japan might step in. But I am not trying to time a Japanese yen intervention. I'm just saying, don't be surprised if we drift up there, that we actually have, and seasonality wise, typically the yen, if it's going to strengthen, it's usually a late in the year move. It's a November to January, end of the year type move. And if that is the case, we could see a nice, couple thousand pip retracement, which would be great for Forex traders. But man, tough to time that BOJ stuff. So trade.
Yeah, no, it certainly is. Chris, I'm going to have to let you go. I'm at home today. Our AC is out at the office, and the landscaping is about to walk by, so it's about to get really loud. So I'm going to leave you to do it. I think Frank's going to join here in just a few minutes.
Okay.
So you'll see from him what he's got in terms of all this volatility, what he's up to. But thanks for coming on, sharing your ideas. Before I step out, guys, if you're enjoying the show, Chris has got his own social media. You can find information on that. We'll drop the link to him there. If you're watching on Twitter, it's at Real Chris Pulver, and I got to run. So enjoy the show, Chris. You got it.
All right. Thanks, Nick.
See ya.
All right. Let's talk dollar index for a moment. Frank pops on here. We'll chat. I wanted to see what my price is on the SPX this morning. We're at 54.60. So I'll look at a little credit trade there. Let me jump into my Tasty account. And also, I'm not sure if anybody saw this. I caught this over the weekend. Is doing some research. Chewy was the latest meme stock. We just ripped from $17 up to $39. I have been long on Chewy, but I didn't get that trade. I didn't get the 130% rip to the upside. We're fading back a little bit, but because there's a bunch of applied volatility, I was able to roll up my calls and out my calls. I just increased my profit potential by $10 if we're going to actually sustain this run on Chewy. So anyway, I go from basically a $16, $17 cost basis with a covered call that was August 2nd at $27.50. And maybe it doesn't get called away, but anyway, I rolled it out and up to $37.50 to give myself another $10 of profit. and also collect another 70 cents to lower my overall cost basis. So I do own Chewy, like $17. But I'll let it ride a little bit. This could be, hopefully, I mean, not just a freaking pump and dump where this thing jumps up to $40 and then tanks all the way back down to 20. I also had some good trades on Chewy this year where I flipped it for about $5 or $6 a share for some of my larger accounts, and that was good stuff, right? So anyway, let me take a look here, get rid of the dashboard to go to my portfolio. This is up about 10K probably 30 minutes ago. It's pulled back a little bit. I'm going to look at some trades in gold futures, silver futures today. Probably just looking to collect some income overall. Staying, tilted bullish on most of those. Index-wise, kind of like where I'm at. We have 5 companies reporting earnings this week, so there's nothing too exciting there. Let me see if I can get in.
Well, that was unexpected. Chris just disappeared. So hopefully he'll be back in a second. There he is. Okay, Chris is coming back right now. Or maybe he's not. I think he's still frozen. So in the meantime, I'm going to sit here and stall for a second. We're all working from home today. Chris has joined back. Chris, are we good? Okay, now we're good. All right, Chris is coming back for real. I kid you not, he just disappeared again. Frank is here, though. Frank is in the office. All right, Chris says 1 second. Frank, hey, Frank, can I pull you in here for a second? All right, I'm pulling you in. Yeah, we're streaming, and Chris has disappeared on us a couple times. I'm not sure. I think he's having issues with his computer. You're in the office.
Yeah, it's hot in here, man.
Yeah, I bet. It's supposed to get up to 90-something today, like it has been the past couple of days. But yeah, we're all kind of working from home today. AC is out in the office. Nick just left to go do some other stuff, and Chris is having some issues with his computer. So we're just kind of stalling for time right now to see if Chris comes back. But Frank, if you want to share your screen and go over anything,
yeah,
I know the people would like to hear your thoughts on some stuff rather than my mumbling I've been doing for the past 2 or 3 minutes.
Right. So you saw, I guess we all had the same news. PMI came in softer than expected. So I don't know. What does this tell us? Is that just another sign of a contracting market, or are we just, are we seeing optimism for the rate cut side? Like what is investor sentiment? And I think this candle and the past couple of candles have told us that no one really has an idea yet. So even if you go down to lower time frames, you see these strange moves intraday. Sorry, I was looking at Chris in the background.
Yeah, Chris is back and he's getting set up. Are you good to join back, Chris? Thumbs up or thumbs down? Thumbs up. All right. I'm going to back out of here and I'm going to let Chris join back in. I think that he's got his thing figured out now. So we're going to bring Chris back in.
Okay.
All right. Frank, man, sorry. So just you're gonna keep the screen. I had this happen on me last week. Every now and then my browser, so Chrome, for example, will start just like sucking all the juice out of my computer. And so I had like a memory leak on Chrome. And anyway, I was down to like one browser trying to keep the stream up. So I'll figure that out and troubleshoot on my own, but sorry about that. So I want you to keep the screen. We'll just talk charts and then,
yeah,
I think it might be time for me to pack in this, trading computer for a decade that's been good to me, but I don't think it's going to cut it anymore. It's been having these issues, and it's weird because it's always Google Chrome. Like I'm running, usually 20 browsers a day, and I try to scale it back, but it's still something's going on. It sucks.
You said it was an old computer.
Yeah, I mean, I've had it for like a decade, but it's just been like a, solid trading computer. I only trade on it. But yeah, it just has some issues every now and then. So last time I took it in to add some RAM, I don't think I can do much to it. It's kind of you got to have the actual like processor be better. So it's time for an upgrade, I think, most likely.
Well,
so anyway, what are you looking at, dude?
So today, no one is here except for me and Hallie. But I think after this, we might head out just because the AC is not working here. So it's like 85 degrees in the office. So when we hit 11, I'm probably going to be done. But today, we started off the second half. PMI was softer, another contraction. Markets sold off, and then it came halfway back in this first 2 hours of trading. So I think no one really knows what is happening. I don't think anyone has a bias. All I can say is that this has been a pretty significant level in the past couple days on the 1 hour.
2 weeks.
And sorry, what'd you say?
I said it's been a level for the last 2 weeks. If we break that floor, that's what brings that CPI gap into play back to 537.
So what I'm kind of hoping for is if we do see a break in this, I see a retest here. If we see a break in that, we go to the daily. I see a retest down to here at 53. But there's so many levels of support that it's got to break that I think we're not going to really see a straight direction down. I think it's going to be like this. It's going to be this weird choppiness, and we're just going to see it grind lower, and it's going to be hard for traders to make money because picking a direction is going to be almost impossible right now. But I'm not bullish, but I'm not super bearish. We were going into a Q3 and interest rates are still expected to cut. I think that's giving the consumer some confidence, but I think cutting now would be pretty awful for the dollar, especially since we see no clear trend lower. But I don't know. What do you think, Chris? What are your thoughts on the market going forward for the last 2 quarters?
Yeah, I mean, there's going to be so much drama in the next 6 months or 5 months of trading. I mean, right now you've got, we've been able to kind of ignore the political spectrum for a while, and now here it is front and center where, you have one debate. Everyone's like, oh my gosh, Trump looks better. Biden might not make it as a candidate anymore. So the Democrats are back to the drawing board. Who are they going to throw? Who are they going to vet out there? They're going to be future debates as we come into the election cycle. Is the Fed going to cut? I guess what I'm doing right now as far as actionable trading is I'm trading right now both directions on the SPY and the Qs through the end of this month. So I do want to see if we have some type of movement. I mean, I showed you that like look back stuff on Tasty and their platform. I talked to Tom Sosnoff. They're going to be rolling out another big update to have like futures feeds and all sorts of instruments where their back testing gets even more robust. But going out like 20 to 30 days, I mean, I like the idea of at least some type of gap fill. That CPI gap on the SPY is around 537. The NASDAQ would be the same type of thing. Just looking to see if the SPY and the Qs will pull back a little bit. They're the ones that are moving pretty much in tandem. So if the SPY is down because of, I mean, I guess what's weird is it going to be because of NVIDIA? Is it going to be because of the broad market sliding? Is it because, is Mag 7 going to get back a little bit of the gains? I don't know. I mean, you have to remember that there's forced buying in the markets every single month, So, I mean, if money's going into more Apple, more Amazon, more Google, more Microsoft, NVIDIA, I'm sure is getting lots of love too now that it's number 1, 2, or 3 in the world of the SPY. Look, April. If you look at how April behaved with the sell-off, April was a grind all the way through March. I was actually bearish timing in March. Let me fix my camera here. I was actually bearish going in through thinking, okay, January drift February, some momentum. I'm looking to see a correction. All the technicals I was looking at, March, I was looking to get short. I should have just played both directions. And eventually we got the short, and I made some nice profits in April, but I was wrong like on 2 trades going into like middle or late March. I could see this summer being the same type of thing. As you expect to be wrong, or you expect to be short, maybe seeing some bearish corrections in July. But if we have low volume and this week is, holiday on Thursday, FOMC minutes Wednesday, non-farm Friday, there's enough to move the market with kind of a low volume, like the market just takes a quick dive or a quick rip. But when kind of steady volume returns, if we dip down, I could see it stabilizing and being bought right back up. If the market rips higher, I can see it fading. It's like I do think that we might just enter a period where the market doesn't know what it wants to do, right? If the market doesn't have a clear path, and it's like your chart's a perfect example. Are we breaking that trend line in the SPX? No. So as a bear, we don't have any confirmation. You're just looking at a floor over the last couple of weeks where if it breaks, yeah, we could go a little bit lower, right? But is it a bear market? Is it a, more than a single digit sell-off? Probably not. So from a technical side, I say it gets really choppy, which means what I'm trying to do is generate income. I think to do that, you go out 45 to 60 days. You don't try to pick a bunch of directions. You just go out what the market wants to do and stay in this positive drift environment, which is we just grind. We grind sideways, make money on out of the money puts. We grind up, you make money out of the money puts. We fall down. You can take some assignment, you can repair trades, you can take small losses, but you give yourself time and price cushion to be wrong essentially. But I'm just not super bearish, dude. I mean, I get that we could have a case for bearish, but look, if I'm bearish, I'm long VIX, which I am. I'm long bonds, which I am. I'm long gold, which I am, right? It's like I have trades that if we go bearish, there's other instruments that will perform for me. So for me to take, just a bearish outlook on the SPY or on the SPX or on the indexes in general, I'm just not. And part of me hopes, and it not hopes obviously, but part of me wonders if the small cap trade is going to still be a good opportunity, going into this year. By the end of the year, is the Russell back up to all-time highs. I mean, one thing that would be really celebratory for the markets would be we continue to see all-time highs in the SPX or the SPY. We continue to see all-time highs in the Qs, but the catch-up trade would be the small caps.
Yeah,
right?
I think the most interest rate sensitive index will probably, I guess I can see it doing well if there's a rate cut.
Yes.
But I think it won't last. I don't think it's a lasting rally for this sort of thing. But I wanted to show you that. So yeah, we didn't break the trend line yet, but even when we did this trend line started in November of last year. Even when we did break the steady grind up, we thought this was the reversal time, but it wasn't. It started another trend line. So right. I don't know how it's impossible to figure out when you think the market's turning to this bearish overall sentiment where we're going to enter into like a 2022 or some long-term lower trend. It just doesn't happen. So even if this breaks the trend line and we come down to say this bottom, it could easily start another trend upward. So it's really hard to tell. I think your best bets are just going long, but when you're not long, or when you are long and you're caught in this sort of move, you're kind of screwed for a while. So it's just when you see a steady trend like this, wait for it to do something, make your move. I don't know. I have small short positions just in case things happen, but for the most part, I'm just kind of betting on these longer moves upwards. I'm not bullish, which sounds counterintuitive, but I'm buying, so I guess I am. I don't like buying here.
Yeah.
But I'm taking smaller risks than what I used to.
Sure.
I'm more weighted to the upside, but I have small short positions just in case. So I'm basically hedged. I think the market has run way past where it needs to be. And it's going to come back at some point. It's just when. And in the meantime, do we want to miss out on 3 months of this, or do we want to be a part of that until the correction happens?
Sure.
So-
Well, I mentioned this earlier with Frank. With Nick. Type in JNK. Okay. I think this is something that, you know, you and I should continue to pay attention to, because if we're going to see some type of aggressive sell-off, just compress that chart, go to a weekly, go to the daily, compress the chart, and look at the correlations with when we see the market selling off. Look at what JNK does. So if you go back to April, and you can see that JNK was down a decent amount in April. Okay, go back to, I mean, our last real rip to the downside was 2020. I mean, since you go to 2022, you're going to see that JNK was going down. 2020, you're going to see that JNK was going down. 2008, of course, you're going to see that JNK is going down. So this is like the widening of credit spreads. This is the availability of liquidity. This is where risk starts to really poke its head out early. I would say if this is a slightly leading indicator to see where, you know, the market's getting a little bit, you know, long in the tooth, or the market's getting a little bit iffy on if it can sustain these levels. And so if you can look back and correlate these big drops in the markets relative to the JNK going down, I think that's one way to kind of simplify your trades. If you want to be bearish, this almost has to start breaking, you know?
So you're talking about lower prices on junk bonds?
Yes. So basically, when it's junk bonds, it's high yield, right? So high yield, it's like it's high yield, it's high risk. So if riskier assets are starting to be less attractive, that means that risk appetite is starting to dry up and it's starting to be more conservative and a flight to safety. So this is a good indicator to tell us if we're starting to see a flight to safety. So whether that's a rotation out of tech into other things, if that's a rotation into safety, if that's a rotation into bonds, if that's a rotation into gold, that's a rotation into a lot of things. I don't know if, you know, the one question, it's like I would hope that value can outperform, because I think, you know, anybody, like, look, I've been trading for a long time. I know a lot of investors, you know, smart investors that had a great run in value from the early 2000s when the tech bubble burst, right? But I think the problem is we are such an entrenched tech market now in the US that I don't know if value will ever outperform the same way that it did during that time, unless we have a crisis. But I don't think that our tech right now, it's not overvalued unicorns. It's like NVIDIA fundamentally has a ridiculously strong balance sheet with you know, margins. I mean, you're paying for ridiculous multiples, but you're actually validating it fundamentally. The dot-com bubble was not that, right? The dot-com bubble was probably our closest thing we saw was in 2020, when you had SPACs and you had all these like shortcut IPOs that it was just like a blank check going to market and everything was up. Well, 2022 did away with all that. So I don't know if, you know, value is that much more attractive unless you want zero gains. You know, if you think about trading, I mean, look at a grocery store, look at a consumer staple sector. I mean, you're just getting, that's the grind. It's like your value is more of a grind. It's just not as volatile. I think that's the difference. Is now value is going to be more of a less volatile, not as big of the drawdowns, not as much of a reaction, and value might just stabilize. But if you want outperformance, it's like you just have to have tech in a good space. So anyway, my point is, this is what I'm watching. I think that if we start to break in a big way to the downside here, then I could see that the market start to accelerate, you know, more to the downside as well. But as it stands right now, it's not. I mean, the VIX, of course, can spike up, and you know, look, my timing on the VIX might be dead wrong. I mean, I'm long through August with like a $12 VIX call. And I mean, I'm hoping we have a bit of a mid-July sell-off, because I'd like to see the VIX spike up to like $16 or $17. You've got 20 on your chart right there, which I would love. I mean, that would turn my call would probably be worth. I think I bought the call for like $1.25 or $1.50, and it'd be worth maybe $4 or $5 net. So, I mean, I would take that as a decent hedge. But it's not moving off those floors. If we don't have a decent sized sell off, like the VIX isn't going to go anywhere. So anyway, I mean, those are two things I'm watching. If I'm going to be more of a, hey, we should be really careful on this potential bear threat, this is what I'm watching. You got to see the VIX spike up, and you got to see the J&K break down.
Right. I've got, let's see, for VIX, I have July 24th call at $14. I paid
Okay.
$159. So I would like to see it above 16 by the end of the month, but if not, then I'll take that loss. But that's what I mean when I say I have a small short position, because the rest of it is just, looking for either spreads or just simple calls to the upside on the SPY. But today I've kind of been out of the market. I haven't taken any trades today. I'm just kind of looking around. But yeah, today didn't start off super hot. It's not showing anything of promise. Even though July is historically a bullish month, or like one of the most bullish months for the markets, it's just last month and the start of this month kind of show, things are looking dull here. But I mean, that's just the start. We could end much higher. This could be a setup for another run to the upside.
Yep.
But we'll see.
Yeah, and I mean, and the reason that June, July tends to be bullish is it is definitely a lower volume market. I mean, I think if anybody is really waiting or anticipating a correction, it's going to be Jackson Hole in August. It's going to be September with a very typical September effect. There's typically tax loss harvesting going in. There's any bad positions are being cleaned up by usually September, and then everyone's looking forward to a Q4 that's arguably very, very bullish. But we've already debunked, like, the sell and may go away doesn't work. I mean, historically, October to April performs pretty much the exact same as May to September. Or I guess November, April to May, October, it's pretty much the same thing. So anyway, I mean, I like out of the money puts. I like out of the money. There's some like put condor is a pretty good trade if you want to define the risk. There's a combination where you can do like a put debit spread plus a naked put on underlines you're willing to own. You can collect income on that. I do that a lot on futures trades. So right now, I mean, probably one of my trades I'm looking at this week to get positioned for the next like 30 to 45 to 60 days. I'm just going to look at long silver, long gold, do those in the futures market. Maybe an index, but I'd like to see a pullback, Frank. I'd like to see a pullback towards the CPI gap. But I think gold futures and silver futures look pretty good for right now. I put a bunch of underlines in last week. So I think I did Google, Apple, Amazon, Tesla, NVIDIA. Those 5 were in last week for like that same thing, like that 30 to 60 day cycle. But gold and silver futures, I kind of like those right now as something that I don't expect there to be a lot of direction on either one. And so if I'm out of the money and I can collect a couple of dollars, per contract, I'll just do it.
So you're saying you're going to strangle gold prices?
Now I'm not going to strangle it. I'm going to stay bullish overall with just having puts as my underline. So,
okay.
So basically what I do is I could do just a straight up like wide credit spread and just keep it really simple. Go out of the money, do a wide credit spread, collect some income on that. Try to grab about 25 to 50% of the credit that I receive. And that way, if I went out 60 days, I can usually close the trade up within like 20 or 30 days. But the other one is you do a put debit spread in case you want to have any downside risk. And if I want to take ownership of the underlying, I do that on the SPY a lot. I do that on the Qs a lot. But I think just gold futures, I might just look at a larger credit spread. I might look at like a $2,000 to $3,000 buying power reduction, or look at like a $2,000 to $3,000 risk, like a 1.5% risk. But if I can take that and generate, maybe 3 to 5% off of that credit received, I'm okay doing that. So I just think directionally, like silver sideways. Silver's in a bit of a correction, but I think it's postured well to the upside. Gold is totally sideways. And as long as we hold that, 2280, 2275 zone, I think silver is strong around that 29 pullback. I think gold looks solid at a decent support level at 2270. You've got that trend line showing right there. It's like, yeah, if we get another nudge above 20, I guess it'd be like 2400, 2350 to 2400. We get above there with some clarity and confirmation. I mean, gold gets back to the highs around 24 and change, 25 and change. But I've got a measure move on gold to 3,000. I don't know when, but it's like if I was looking out 12 to 24 months and gold's going to stay in this uptrend, 3,000 is pretty exciting. If silver goes to $35 to $44, that's pretty exciting. And again, what I like is right now, if I'm long on something, I want to have a measured move to get there. I want to have a justification technically to get there. The hardest thing right now is staring at an index like the SPY or the Qs and thinking we're going to all-time highs again and again and again. It's like, well, when does it stop? Because it's not like you don't want the markets to go up, but when they go up and they're overbought with divergence and it seems like it's a low volume drift, it's like all it takes is something to snap that back. And I mean, we can go up 15%. And here's a real example. Let's say we go up, 25 or 30% on the indexes this year. That could easily pull back 50%.
Yeah.
Right. So, I mean, you could be up 25 to 30% and the market can have some type of sell-off, and we give back months and months and months of gains in a short amount of time. And that, of course, is like the scary part of being, fully invested and correlated is if the market's going to sell off 5 to 10%, you're going to go right along with it. So it's hard to be, all in the SPY because most of the time you're going to take on about a 3x risk for what you get. If you get 10% a year in the SPY, you're taking on a 30% risk at any given time, always. And that's
the higher we run, the worse it'll be.
I do not disagree. I think that's the scariest part is these booms and busts we have seen way more than, I mean, you can go back to 2018. We've had essentially booms and busts after we got out of the financial crisis in 2008, bottom 2009. It's been a pretty good uptrend for the most part, but we get into the last 4 years, especially 2018 end of the year with the rate hike cycle. We had a 20% haircut in 2018 in December. That was like a crazy crash. And then it was backstopped by the Fed in 2019. 2020, COVID crash. 2022, deleveraging, right? I mean, these have been literally boom and bust cycles. And they're backstopped by the Fed. It just seems like it's not a healthy rally. It's not a healthy market. But the way that it gets in these booms and busts, I don't think it's going to change. If the market's down, the Fed's going to do what they can to backstop it. They're going to do what they can to cut. I just think the difference is the Fed may not be going towards 0% interest rates, hopefully ever again. But if they do, it's the same song and dance we've seen for the last, decade plus. So anyway, I mean, it's not easy. I think the positive drift is for real. I think the market, if it goes sideways, it's going to drive traders crazy, Frank. I mean, if it goes sideways and it's like, man, we can't get any direction. It's very true. I'd rather do this. I'd rather trade and make money with no direction. I'd rather trade and make money with a little bit of downside, because I think that's the reality is we have little downside. But if we go a little down, nowhere, up a little, up a lot, I want to make money those ways. That's 4 out of 5 ways to make money. The way I don't make money is a big fat collapse, which I'm hedged for, which I can also manage some of that drawdown and alleviate some of the pain. So, I mean, from that sense, if it's really bad, I'm okay and I'm protected. If it's down a little, sideways, up a little, up a lot, we make money. I'd rather do that than try to be, crazy bullish and crazy directional or crazy bearish and crazy directional because, I just don't think it's profitable to position for a black swan event when you never get it. There's a reason a black swan event is every, 10 years, every 20 years. It's not every 2 months. It's like right now it seems like the market, like it's got to go down. It's got to crash. It's like, why? It never does. We just had a crash in 2022. That was a 30% correction. The market is now recovering from that. And fortunately it's at all-time highs. So I just think we have to use history as our guide,
At the same time though, there's still those red flags, we have, what is it, the 3-month and the 10-year yield still inverted for how many years now?
October is going to be 2 years. We had talked about that. Like that 2-year mark is historically the average when we start to see a recession. So, could the market kick it back a little bit? Sure. If the market is going to kick it back where, hey, this is 24 months, we stretch a little bit longer, we get through a Q4, we get through the election, the Fed is accommodated by cutting rates a little bit, and the market likes it, I could see that inversion lasting through maybe this year and then flipping hard into 2025 where it all changes. So, I mean, like I'm way more skeptical going into this type of gain and bullishness into 2025 than I am right now. Like right now, I can see there's a reason for, steadiness. If we have a dip, I could see the market dipping and then the market gets really excited through the election for whatever reason to kind of save itself. But I don't know. I mean, I hope the market just remains pretty steady because that makes trading relatively easy. Look, I know that if the market's up, down, or sideways, I'll find a way to make money. But for the general investor out there, passive or active, it's a lot easier to trade bull markets, man. For the average person that's participating, look, I'm a fan of anybody that's interested in trading. If you want to learn how to trade, do it. You should. It's one of the greatest things ever. I love what I do. But for the trader that is learning or the trader that's not prepared for a crash and the pain that it takes to experience a 2022 or a 2020 or 2008, it's not fun. It's easy to look back in hindsight and say like, well, I just bought it there at the bottom and I made a ton of money over the next 5 years. But the pain it takes to see your portfolio go from all-time highs and lose 30%, 40%, 50%, if you're heavily invested in tech, lose 60, 70, 80%, that pain makes people quit trading. So it's a lot easier to trade a bull market. It's a lot easier to see the market drift and go higher, So
well, that's part of the reason why it would be nice to have that black swan event is because you get a terrible correction that is long overdue. And I know we just had one in 2022, but we ran way further than that too. Like these recoveries are much harsher. These crashes are much worse. Yeah. They happen quicker. But yeah, sure. I'm just thinking that if we can just see, if we saw a really bad one, that means probably for the next decade or so, at some point, you will have that those steady gains to the upside. And you can build your portfolio. You don't have to worry about these weird directions and the choppiness day in and day out. You can just keep buying. And that's kind of what I want. While I'm young, I don't want to be going into my 30s in an extremely overbought market. So I would like to see some discounts at some point.
I don't disagree, but again, it's not just about you, Frank. You've got 70, 80-year-olds that have their portfolios at all-time highs that don't need to be invested in equities the way that they are. I mean, think about if you're invested in with a financial advisor and you're a bunch of mutual funds that are 95% invested and 95% correlated with the market. I want to see a crash too, because I'm usually only about 40 to 50% invested and I have a bunch of cash on the sidelines ready to deploy. So I'm doing the same thing, But the reality is, if we have a crash, you're watching portfolios get cleansed. And if you don't have the cash to buy again, you're just hoping that it comes back. So you and I are, as traders and investors, if you have money on the sidelines ready to deploy, you want the crash, you want the correction, because then you can deploy your cash because it's a good opportunity. But when you're fully invested, and I'm speaking broadly for like the passive investor community, when you're fully invested by mandate, fully invested because you're just in a bunch of mutual funds and you don't have protection to the downside, you go from all-time highs to whatever the market's going to make you, bow to. If the market has a 20% cleanse, your $1 million portfolio just turned to 800 grand and you didn't do anything other than watch it go down. And now you're hoping that it gets back to $1 million plus 3, 4, 5 years later. That's a terrible feeling. So, there's a difference between trading, and managing a portfolio. And there's a difference between just investing and staying invested and just watch the market drift all-time highs. I'm right there with you. I want to see corrections. I saw
you're right. We can continue this later on, or
that's fine,
or over chat or something. But I got a text from James. We have to get Nick Phillips on now because it's past 11. It's 11:03 right now. So
all good. Well, I sorry for my little Google Chrome deal. I'll get that fixed for tomorrow. But good talk.
No worries.
See you tomorrow. All right. Thanks, James. Yep. Thanks, Frank.
Thank you.
See ya.
What is going on, everybody? Just saw Chris and Frank having a awesome conversation. Sorry to kind of boot them off, but excited to be here, guys. I'm gonna go ahead and share this with my audience as well, real quick, and then we will get going. Okay. All right, guys. New week, new quarter. Let's take a look at a couple things here. Let's see how the Doxy's shaping up. Go over here to this chart. All right, so PMIs this morning came out mostly contractionary, but we had a little bit, even though ISM new orders came out contractionary, being below 50, we did get a higher than previous and higher than forecasted number for them. So sort of a mixed bag here this morning. Prices paid, again, above that 50 number, but slight contractionary information from previous and the forecasted expectation. And then ISM headline manufacturing came out below 50, so contractionary in that regard and contractionary as far as previous and forecast is concerned. So mostly contractionary scenario situation happening this morning out of the ISM numbers. But this one right here kind of created a mixed bag, and it seems the market really, it gave this initial spike to the downside here. But I guess we started to price in that this slightly higher than expected new orders, and Doxy just went, continued to push to the upside, giving back some of these losses from Friday of last week, Thursday and Friday. Looks like the dollar is gradually reversing now, giving back all its gains in the last hour. Let's check it out on a. Yeah, it's interesting seeing this kind of push up here the last few weeks of June. Gonna be a really interesting story as we start to get some more data this month. Hopefully, for those of us that are wanting some dollar downside, hopefully we start to see some more solid contractionary information out of the economic data hitting the board. Really interested to see how this quarter goes. Election cycle right around the corner. That should be exciting to trade through. Let's check out the NQ now. I mean, Doxy is just absolutely rallying to the upside this morning. The NQ, I believe, we're down on the day. Down on the morning, not too heavy. A little bit of consolidation here, actually, since about the open. Open here, we're down, but consolidating in this 19.9 area, 19.9, 19.950. So this seems like a bit of a quiet Monday as far as where's price going. We really just have NQ stuck in this range here since about the New York Stock Exchange open. Having a hard time pushing farther on this new leg here after about 10:30. So the last 30 minutes haven't been able to continue to push down. Trying here, but rejecting it out of this 870 area. Let's go check out SPX real quick. Similar story, although a bit weaker. Add some of these. It's at last week's low. Dipping below this point, I think, next batch of support areas will be in between the 54.75 and 55 area, 5,500 area. I think if price dips down into here, we're going to see, at least on a short term, little bit of some price action like this, where then our next contestant area will be in between 550. Looking at the economic calendar, let's go to Forex Factory real quick. I believe CPI is next week. Yeah, CPI being next Thursday. NFP obviously this Friday could give the markets a significant push, but I would almost expect us to hang out in this area until CPI next week. Could be wrong. If NFP gives us significant cooling, that will change the game. But a continued strong NFP, I don't really think is going to factor into the market too much. The Feds have been saying for a while that strength, since I want to say April or May, they've been saying strong labor data isn't necessarily going to, factor in too much into their monetary policy decisions. So another strong NFP print, we may get some temporary volatility out of the dollar pushing up, but I don't know if that's going to be enough to continue to push it and maybe break some of these 106, 106.5 levels. But weaker NFP, significant cooling in the NFP could see us really fall to the downside. I would definitely expect a significant cooling in the labor market to give us that doxy weakness, some initial doxy weakness, and if we get cooling, follow that up with some cooling with CPI, and we may be in the running for that those pullbacks here on the doxy, which is honestly what I'm looking forward to. Hoping we start to get that personal bias, wanting some of those interest rates to start coming down, so I can more comfortably start to look at buying a house, because these current levels are not enticing. So let's see. If you guys trade in metals with different trading currencies due to high volatility of the market, I think you're right. If you guys have anything you want me to check out, feel free to drop them through the chat. It's a Monday. I'm usually not too interested in trading on Mondays, depending on the data set hitting the market. Tried to take a stab at the PMI numbers this morning, even though it was mixed. I maybe should have stayed on the sidelines and avoided a unnecessary little 0.5% loss there on my account. But it is what it is. We took a stab on odd USD, really the odd futures. Tried to take a stab at the buys here, lower time frames. We got this initial spike up and started to try to grab some buys down right here on this leg as we started this push back up, and just ended up getting tagged out here below the structure point. So good thing though, proper risk management, got out, had a good idea of where we wanted to get out, and we got out via our rules. The market continued to tank to the downside for the odd. Let's see, what are we looking forward to this week? I mean, the big thing is NFP. I don't know that I'm going to be paying attention to this Fed chair or this Powell speech tomorrow. JOLTS job openings will be a good one to factor into the overall labor market, as far as, are we going to get softening? market is expecting a softening number, a little bit less demand for labor out of the openings here. That's what we're expecting. So if we can get significant cooling here and then significant cooling on the NFP numbers this week, I think we will be well poised for a contractionary scenario here out of the economy. Let's see, my projections on gold is a massive bullish push to the upside. Then my projections for NFP is a massive drop in favor of the dollar across all dollar pairs. So you're saying you're expecting a drop in the NFP numbers? I don't want to butcher your name, Chidu. Gold is always interesting for me as far as a tradable opportunity out of metals in general, but specifically gold. I tend to really only trade gold in risk sentiment, like heavy risk off scenarios where investors are dumping their money into gold because a new war pops off, for instance. Those are the best times for me. The most how can I say it? I like to identify that what I deem to be the highest probability opportunities in the market. And so with gold, the highest probability opportunities for me always are, if we get a new war that pops off right here, where price is trading in these areas, and all of a sudden, let's just come up with two random things. Mexico attacks Venezuela, and it's a brand new war that hits the market. Well, then all of a sudden, the odds are gold should start to rally from that point. So for me, that's how I like to trade gold is really like a safe haven in times of war. Gold on 2-minute performance. How's gold correlating with the dollar this morning? Gold is sort of as far as the 2-minute performance goes, we're just in a bit of a pullback here from these down legs. Let's just mark off a couple technical areas here. We got a high, then a low, then a lower high, and a lower low, and now theoretically making a lower high here at this previous resistance level. On the 2-minute, of course, looking at scalping opportunities, potentially selling out of this 2339, 2340 area, somewhere on this leg back up. Yeah, I tend to only look at gold during wars. I tend to not trade gold unless a war pops off or something else happens in a war scenario that is pretty big. I should have had this prepared for. I'll try to prepare this for next time. There was a specific date a couple Sundays ago where the market opened. It was I think it may have been a Wednesday. Anyways, it was Asia market open, and the chief of staff of Hamas got killed in a bombing. And so not every bomb once the market reacts to a war, like let's say Israel and Hamas popped off, I think on October 7th, October 9th. The market reacted for a solid few weeks. Well, then after that, we still get little headlines about there was a bombing, it killed so and so many people, Israel's going to react, or Israel bombed Hamas and so many people died, and Hamas is preparing to retaliate or something. Like at some point, the market stops reacting to those headlines once it's already kind of factored in the war itself. And then it's going to take something sort of a new major headline, in my experience, a new major headline to get that risk off sentiment to factor back into the equation when it comes to gold. So when the chief of staff of Hamas got killed that Wednesday afternoon, literally right as Asia session started, I got the notification about 20 minutes too late, but I went and looked at the chart. You could see gold was starting to, it was on a bit of a downtrend, and then that headline hit the markets, and within 2 minutes, gold started rallying to the upside. So, safe haven flows in that regard, for me, seem to be the explanation. Again, it's not every headline after the market adapts to the idea that a new war has happened. But you can see here, let's see, what time is it? 11:20. Let's back out to, I've gone over this before on the stream, but I'll touch back on it again. It was a Saturday, October 7th, I believe. So yeah, it was Saturday, October 7th. The Israel and Hamas war, like really, it kicked off this last time. I know there's a long history there, and I'm not an expert in it, but I know that October 7th was like the big, most recent Israel and Hamas, or Israel is at war again. And we immediately see the market price in war tensions. And then it started to fizzle out here. So I believe, what is this, 2 weeks later? Within about 2 weeks, the market had sort of priced it in. And then I wish I could remember the exact date that the chief of staff died. And for whatever reason, last time I was Googling it, I couldn't find anything on it. But it was, I want to say it was in May, or it was either May or June. And it was like a random Wednesday night around Asia session. Do you hold actual gold coins? No, I don't. I've considered like buying some, but I don't. Most of my investments have always been tied up in real estate, like outside of the market. It's, I don't really hold anything physical other than real estate. But I have considered getting gold coins. I think even if it's just out of like this would be cool to hold. That's kind of my idea behind having gold. Now, if I was to start seriously investing in gold, it would, that's a completely different story. And I would have wanted to do that maybe at a different time. Like, it would have been obviously Hindsight Capital, Hindsight Capital Group. It would have been amazing to start buying up gold 10 years ago, but I was 18 at the time, not thinking about this stuff. So, but yeah, I don't know if I would buy physical gold right now. I mean, you could. If I was to do it right now, it would just be for the cool factor of having some gold. Where are we going with the euro dollar? Let me check that out. Euro is interesting right now. I actually have not checked on the status of the elections. It's a recent low here. Weekly is kind of stuck in a range. I think a lot of where we're going to go with the euro dollar is, it's going to depend on a few factors. Monetary policy obviously being one of the biggest ones. I think what's going to happen here with the euro dollar, potentially, if we don't get my ideal scenario in the US, which my ideal scenario in the US is weakness out of the dollar. We start to look at cutting rates, like a serious, significant weakness out of inflation, significant weakness out of the labor market, so that the Feds can start to seriously consider giving the market the rate cuts that at least consumers desperately want. If we don't get that, if we get continued stickiness out of inflation and maybe some continued strength out of the labor market, then I think euro dollar is going south. I think we're going to start to see it break these lows and possibly come back down to these 10, 1045 areas. If, of course, Euro continues to cut rates, which they've been a little back and forth lately, if I remember correctly. Dollar strength looking stronger, only maybe. Euro USD is now reversing in favor of the euro. Euro just hit support on yesterday's highs, currently reversing. Yeah, so Euro USD is interesting right now because of the France elections. I would have to read through these to get a little bit more of a solid understanding. $12 million of our fellow citizens have voted for a far-right party that is clearly... Okay, so this is very political right now. Let's see if we can get any... So I'm going to have to look into this a little bit more. The reason why I wouldn't buy the euro going up, honestly, is because of the political turmoil right now in Europe. I definitely, you wouldn't see me buying this right now. Maybe on some scalping scenarios purely based off of technicals. You know, we start to hit some support areas for sure. You know, which obviously we're coming down into this previous resistance zone here, which could prove to be a decent area for potential scalps. You know, if you're just thinking about it on a technical standpoint and not really taking any fundamentals into account. Yeah, I think in this area you get the right kind of price action out of the market here. The market shows you, you know, that it's trying to push maybe below this and can't. Tries to push a couple times, tries to push, and cannot break below this 107.15 area. Then yeah, you know, buying up, scalping it out of here. It all depends on your style. That's how I would trade this. I would try to scalp it out of this area once I get proper price action. And we're coming towards London close. I'm not sure that I would do it today. If you were going to be looking to scalp this out of here, I would see if we hang out in this area until London tomorrow. And then if we're still in this area, you know, even if we pop up and pop down and pop up and pop down and pop up and pop down, if we're hanging out in this area tomorrow ahead of London open and you start to see some volume to the upside, I think this is a prime area to start, you know, taking some scalps to the upside. But as far as long-term swings either way, I'm not touching the euro dollar right now, mainly because of the political tensions going on in their country. Can I see big unrest in Europe this summer? I mean, you kind of already see it. I guess big unrest is sort of, what is the word? It's relative, right? So we saw the euro significantly fall off once snap elections were announced. And so that sort of political turmoil creates some unrest in the area. Anytime you have any kind of surprise political situations, it's going to cause some unease. It's going to cause some fear, uncertainty, and doubt in the area for sure. All right, guys. I think that's about all I have for today. Again, it's a Monday. I'm really not looking to get involved in anything else for the day. I'm gonna let the market hang out and do its thing. We've got July 4th in the U.S. on Thursday, so interesting week. We have quite a few pieces of economic data, but we also have a major holiday. I started hearing noise. I was like, "What is going on? What's up, Nick?"
Sorry about that. What's going on, man? How you doing?
I'm good, man. How are you?
I'm good. Yeah, busy, like you were saying just a second ago. Busy week this week, and should be a good one. Are you? I think you're coming back a couple times this week, right?
Yeah, I haven't checked the rest of the schedule yet. The last time I checked the schedule, today was the only day that I had. But yeah, I think I let you guys know I have plenty of availability this week. The only time I'm not going to be available is on the 4th and then tomorrow. So
Sure. Okay. Awesome. Well, Nick, thank you for coming on the show and hanging out for a little bit. For anybody who's listening, if you enjoyed that segment, you can find more from Nick on his own YouTube channel. We just dropped a link to his right here, official Nick Phillips there. Check him out for sure. And Nick, thank you very much for coming on and sharing some thoughts.
Yeah, no problem. All right, guys.
All right, man. See ya.
See ya.
All right, guys, we're going to go for just a few more minutes here. Just wanted to kind of follow up with where things are at here for the day. Gold is completely flat on the day. The dollar index is higher on the day. Really impressive kind of turnaround for the dollar index. We did hit that 105.5 level and just boom, shot right off of that area. We'll see how that progresses, if it can kind of continue pushing one way or the other. It may be that the dollar index is headed up to test that 106 kind of range, 106.4 that we keep talking about. We'll see what happens there. If it does get up there, my opinion would be it's probably extended unless something changes with the NFP report this week. If you get a really hot jobs data point, the dollar could continue higher. So we'll see. I am sort of neutral on the dollar. I've stayed neutral. If anything, I lean slightly bearish just because I am bullish on gold, bullish on silver. WTI really making a move here this morning as well. Could be increasing inflation concerns. Yields are up on the day. Longer duration getting even more of a boost today. So kind of interesting to say the least. Bitcoin, I do have a long position on Bitcoin. It was up this weekend, giving back a little bit of gains here today, but I am still long Bitcoin. Ethereum, I don't really have any positions on. The euro rejecting this level, seems at the 1075 level. Pound USD also rejecting, selling off. And dollar yen continues its climb, its endless climb, it seems, higher. There's dollar Swiss completely taking out resistance. I thought we would get a more reaction here. I didn't take the trade, but obviously I'm glad that I didn't, because it would have probably been a loser for me, but I didn't touch that trade. The Australian dollar also rejecting again off of these highs. I would like to be long the Aussie dollar if we get a breakout through the highs. I've talked about that recently. So we'll keep an eye on AUD USD. If I take that trade, I'll share it inside of our Discord room. And I just also wanted to mention, guys, if you haven't already messaged us about the sale, we are currently doing our half off sale here for the Edge Finder. We're doing a summer sale this week. It is a short-term sale here. So if you are interested in getting a copy of the Edge Finder at a massive, massive discount, the price is half of what it usually is right now. And it will be going back up shortly. This is the biggest discount of the entire year. I mentioned this earlier. If you're like waiting for a good deal, it won't get better than this. This is the lowest that it goes. So if you've thought about getting a copy, we're going to drop a link here in the chat to where you can get some information for that. If you click the link here, it will take you to this chat location where you can speak directly to a representative on my staff who will get you set up with a copy, get you some information. So just hit that, click the 55% off summer sale. For people who are watching with us live right now, you can get 55% off the Edge Finder. And by the way, you can bundle the membership with it. If you're thinking about getting that, you can also get that for a super discounted rate. So come trade with us, get access to our tools, whatever you'd like to do, and take advantage. That's going to wrap it up for the show here today, guys. Thank you for hanging out with us. And thanks to all of our guests and audience for being a part of what is the A1 Trading Show. Thanks so much. And we'll see you back tomorrow. See you guys.
Software is constantly scanning for new data and information and is updated regularly. The Edge Finder is a one-time purchase, which means you can get it half off right now and never have to pay for any updates made to the Edge Finder software. This limited time offer won't be around for very long, so don't wait and get this incredible trading software for half off before it's too late. Check out the link being dropped in the chat now to talk to one of our team members about our huge 50% off summer software sale.
Thanks for tuning in to today's A1 Trading Show. Make sure to subscribe and to turn on post notifications so you don't miss the next one. Also, we're looking for more guests to come on the show. If you're comfortable being on camera, have trading experience, and you're looking to grow your audience exposure, we'd love to have you on. In the live stream chat and description below, we'll drop a link to apply to be a live stream guest and join in on the conversation. We hope to have you on soon. That's all for today. Trade safe, and we'll see you next time.